And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. What a day. Okay. So, people are getting really confused what's going on. So I'm going to explain to you what happened this morning. What happened? We woke up and we had a yield at 4.4%. That's the kill zone. Now remember, 2020, 2022, we hit the kill zone. And those years, 2020, 2022, that's when all of a sudden the big institutions stopped buying tech. But this morning we hit it again. So I don't know if anybody's ever been, if you're a boat owner or not. If you're a boat owner, I'm sure you've been through this, okay? Maybe this happened to you, I don't know. But you ever wake up in your boat and you put your feet on the floor, you roll over, put your feet, and also it's wet. And also water's up to your ankles. I think every boat owner has experienced that. Well, that's what happened today. The market rolled over, and instead of water, everybody up to their ankles with money, cash. See, usually there's not that kind of cash around. Usually that cash finds a home, and it's always in T-bills, short-term T-bills to pay about 5%. Now, you don't get 5% now, okay? They're probably about, I think I'll look it up, but probably about 3.5%, 3.6%, thank you. So that's what happened this morning. It's very unusual, okay? Because all this cash, people are taking their money. They don't want to be in tech stocks anymore. I mean, who wants to be in tech stocks when you can get paid big yields on non-tech stocks, buying these treasuries? And so that's what happened. So, but here's the crazy part about all that, is that, again, it's not inflation that's pushing up, okay? It's the yield that's killing everybody. And it's hurting the stock market. It's wages, but they don't want to tell you that. They tell you how strong wages are. No, we have more companies. They can't fill the jobs. They have a ton of jobs, but nobody's working. Why? Because the kind of jobs that they're offering are very weak healthcare service jobs, mostly part-time, and people don't want to get involved with those jobs, because if they get another part-time job, they go over the threshold, and all of a sudden they're losing different kind of government programs. So the big problem we're having right now is that businesses are offering money, a job that's paying $15 an hour, right back to COVID. They're paying $30, $40 an hour, okay? So that's what's going on. So when you hear how inflation is pushing up yields, no, it's not inflation pushing up yields. It's wages pushing up yields, because they're too strong, the wages, and that will hurt us, okay? So yields are staying high. And that, again, when you have that kill zone around 4.5, the big institutions, they're not going to buy. Now, let's go back to, remember, 2022, 2023. 1 month, 2 months, 1 month, 3 months, and 6 month T-bills were paying 5%. And that's when the tech market started getting hammered, okay? And that stopped the institutionals, okay, buying these AI mega cap stocks. And they still aren't buying them. They're not coming in the market. And they were dumping back then these stocks and getting 5% risk free. Well, today those same T-bills, they're not at 5%, but are 3.6%, 4%. People are saying, why am I going to go buy tech stocks? I can put my money into a T-bill, and I have no risk, and that's what they're doing. But they're not going to tell you the truth, why it's happening. So the cash, when we woke up this morning, we got all this cash that should have been in short-term T-bills, and even at 3.6%, even though it wasn't 5%. But no, what happened is the Fed says, no, the Treasury, no, we're not going to give you any more. You can't have 5%, okay, on your T-bill. We just can't do it. Because what happens is, as the government keeps borrowing and borrowing more short term, then what happens is it starts hurting the country. Because when they keep borrowing and borrowing short term, and they borrow by month or by week, whatever, and they have to keep rolling them over. And when they rolling them over, the bondholders want more interest. So the government already has, let's say, a $2 trillion debt. That's bad for them, because we keep paying the money's been costing us on average 5%. So again, these yields where they are today again is a killer. And so some of you're going to say, well, yeah, it doesn't seem like the market was too bad today. It takes time. It takes time. It's like when you raise the rate or lower rate, it takes a long time before it hits the market. It's like trying to turn the Queen Mary around with a canoe or instead of a cigarette boat. So what we have right now is wages keeping yields very high, and all these people, all they know is tech stocks. Okay, some are still in there buying them, and they're going to get crushed. They're going to get crushed at some point. So, and I got a few of the stocks. I put them up here for you. I want to show you what's going on. If we can, let me just see. If we can get, so this morning, I told everybody, let's put up, I'll get them up here for you. Let's get these stocks up. And we'll watch them today. And what we'll do is let's put up the stocks that everybody buys. Okay, let's put up the stocks, the Nvidia and AMD and AVGO and Meta and Amazon, Google. Those are the stocks that been driving this whole stock market since 2008, 2009, and then in 2020, 2022. Okay, that's when. They got hit because they were competing with the bond market of 5%. So today, Nvidia, okay, it couldn't hold its high this morning on the opening. AMD, okay, could not hold its high. And that's what you got to learn to watch your Pro 3 in the morning to see, is it holding their high? A lot of people, what they do, the minute the market opens at 9:30, they'll turn around and they start buying, and they don't realize they're going to get crushed because you want to wait till about 5 after 10. So let me just give you another one. AVGO, that pulled back off its high. Meta is the only one that held its high. We had Amazon, that pulled off its high. So I can go on and on. Now the banks, okay, they like high yields. They love high yields. But the banks, you got to be very careful with the banks, because remember, we have so much trouble going on with the banks, that credit cards and I think it's 42% of the folks that that finance their cars are upside down. They owe more on the car than it's worth, 42%. So if you take a look at these stocks, so take a look, for example, at J.P. Morgan. All right, take a look at Wells Fargo. I mean, Wells Fargo is very big. Bank of America. Now BAC, that would be a wonderful short if it breaks through $50.20. So the banks are getting weak. Now the small banks, KRE, the small regional banks, we need them to go up to push up the small mid-cap stocks. Because if they push up the small mid-cap stocks, so if you have KRE pushing up the small mid-cap stocks, that's good news. That strengthens, okay, the economy. So right now, and we watch every day to make sure that you have the Nasdaq, the S&P, okay, and Nasdaq, S&P, and the Dow. They've got to stay green. Now, I'm sorry, IWM, the S&P, and yeah, what was it? Which one was it? Yeah, Nasdaq, S&P, and IWM. Those three. There you go. Those three have to stay green because if IWM rolls over, turns red, the other two don't roll over. That's telling you you're going to have a big correction. So you got to watch that. Remember, it's your Treasury yield and your IWM that tells you what's going to happen with the market, and it's never wrong. So again, these banks are not doing well at all. Now, even though the yields are high, because people are in deep trouble with their cars and credit cards and everything else. Now, we also have, don't forget, the regional banks, the small banks, usually doing well. Matter of fact, we made a lot of money trading the regional banks not too long ago. And now the regional banks are ready to break. They're ready to collapse. That's bad news. You can't have a market healthy when you got yields like this. I mean, you just can't. You can't have a 4.4% yield and expect the market is going to survive without having a correction or a crash. Now, it doesn't happen overnight, but you've got to learn how to sell short. You got to. This is where people lose a ton of money because they don't know how to sell short. So, now the other thing is all these staples, like people will run to Home Depot, people will run to Budweiser, and even these guys aren't doing good. Staples aren't doing good. Now, one stock that we've been working for energy, we've been staying with Halliburton, Baker, the oil services, and we're doing pretty well with them because the good thing about oil going up and keep the price goes up, the oil service sector, those stocks go up when oil prices go up. So big oil companies like Hess and Exxon, all those go down, but not the oil service. They go up because when oil hits over $100, then all the big oil companies, Conoco, Exxon, all of them will call Baker Hughes. I was in that business, and Schlumberger, and say, "Hey, oil's up over $100 now. We're going to start some more drilling." And we need some crews, we need some rigs, so can you send over some crews and rigs? And so that's why you're seeing those three stocks go up, while the oil stocks, they're much stronger than the oil stocks. So I'm looking at Halliburton right here. And Halliburton's had a nice run. We're doing very well with Halliburton, we're doing very well with Baker, and Schlumberger we're doing well with. You got to watch them every day, especially in the morning. You got to make sure when they open at the high and they stay at that high. So there's a lot of things going on right now, but the whole market is in trouble because where the yields are. And the yields are high because the labor market's in deep trouble. there's so many jobs available, but nobody wants to work them. Nobody wants to work them. That's the big problem. So hopefully it doesn't put us into a crash, but if it does, we'll be ready to sell short. That's all. It's a nice thing about knowing how to short, you know? You never worry about the market. Whatever happens, who cares? Because we're prepared to make money long and make money short. So have a good evening. Thank you for listening. Join my gang, philsgang.com, free for 10 days.